Hello and welcome to a brand new episode of Smart Money. Now, while planning your financial journey and building a corpus, it's important not only to focus on what to do, but also to make sure what to not do or what to avoid. Now, this is a market which is cluttered with financial products and schemes, but we are here to demystify it for you and make your investment journey smoother. Today, we talk about 5 things to avoid in your financial journey. Our expert is Kirtan Shah. He's the founder and CEO at Credence Wealth Advisors. Kirtan, thanks a lot for joining in. Let's get straight to it, right? I've put down 5 or 6 things that one should be avoiding in your investment journey, and I wanted your thoughts on it. So the first important tool that we're looking at is to never mix insurance and investment. Now, what I mean by this is when you mix an insurance and an investment product together, you end up paying heavy charges for your insurance scheme along with suboptimal earnings returns in your investments. Now, the 2 schemes which are a strict avoid according to me are Ulips and Endowment or money back plans. So let's first talk about that. Endowment plans, Ulips, why you should be avoiding it. Kirtan, jump in on this. There are a lot of these schemes which are sold to investors and are sort of sold with this promise of great returns and insurance. But just put that myth or demystify it for us. Why should one not mix insurance and investment?
Hi, Sonia. Thank you so much for having me on the show. Sonia, the prime reason why insurance policies are sold as investment instruments is because they tell you that the maturity is going to be tax-free. And on that, you get insurance, which is an add-on. And like you rightly said, it's the biggest mistake that somebody would end up making in the investment journey to try and mix both of these together. And a couple of reasons why. So look, the traditional policies are very different from how a ULIP operates. So traditional policies are policies in which there is low volatility. They tell you that if you invest 1 lakh of rupee today, probably you'll receive 2.5 lakh rupees after 20 years. Or they tell you or give you a very clear direction of what kind of cash flows can you expect from this investment. Now, the tricky part here is, Sonia, that while these insurance policies bundled with investments are sold to us, nobody in this space talks to you about the XIRR or the return that you will make on the product. They very smartly bundle it saying that you invest 1 lakh today and you will get 2.5 lakhs after 20 years. Somebody who does the basic math will understand that this is 4.5–5%. Now, most of these products, specifically the traditional side of the products, right, the ones that you highlighted, the endowments and the money backs, they don't end up making you anything more than 5–6% on a higher side. So while you talk about investing in this product, there is no investment case because you're not making great returns. Now let's talk about, do you actually even get insurance or not? So typically the rule says that whatever premiums you are paying, 10 times of those premiums is what your sum assured has to be. Only then your maturity is going to be tax-free. So what all of these products typically do is if you paid 1 lakh of rupee of premium, they'll give you 10 lakhs of sum assured. Now for somebody who's paying 1 lakh of rupee of premium, 10 lakhs is actually not a great sum assured in itself. So what typically happens is while you invest in these products, neither do you make higher returns, nor do you actually get covered in terms of insurance because the insurance is too low. Now, the reason why they keep the insurance low is because, let's say if you're investing 1 lakh of rupee, right? The higher your age is, the higher of that 1 lakh rupee gets allocated towards giving you insurance. So let's say if you're 30 years old, some random numbers, out of that 1 lakh, 10,000 will be kept aside to give you that insurance cover. But if you are slightly older, you're 50 years old, so that 1 lakh rupee, from that 1 lakh rupee, 25,000 will be kept aside to give you that sum assured, which means that higher your age is, right, or more the sum assured that you are opting for, less amount of money is allocated towards investments and hence the returns even fall further. Now, along with this problem, another bigger problem, Sonia, in this case is there is hardly any liquidity, right? So while you invest in traditional products specifically, if you get out of the traditional products before the maturity, what they pay you back is hardly anything. 9 out of 10 cases, you go to the insurer and tell the insurer that I want my money back. And if this is prior to maturity, the surrender value paid to you is 40, 50, 60% of what the fair value you actually deserve. So neither do these products have liquidity, nor do these products make you higher returns. And also being an insurance product, it does not give you a very high insurance, right? So this is a big problem with investing in traditional policies. Now, if I have to talk to you about Ulips in specific, The only
Kirtan,
difference between traditional policies and
Kirtan,
Ulips is that Ulip typically allows you to also take exposure to equity.
In
Right.
fact,
So of course
Kirtan, I
there
want to
can
just, I want to just take a breather there because I want to talk a little bit more in detail about ULIPs. So let me first tell our viewers what exactly ULIPs are for the uninformed, and then I'll come to you. Now, investors should strictly avoid ULIPs, and that's my view, and I'm sure that's Kirtan's view as well. So ULIPs or unit-linked insurance plans are products that combine insurance and investment components. Now, investors should also avoid, of course, endowment and money-back policies. But the problem with ULIPs and endowment policies is that no great insurance coverage and there is suboptimal return. So once again, coming back to that. But Kirtan, tell us, what is the key difference between ULIPs and endowment plans, and why should one strictly avoid ULIPs?
See, what happens on the traditional side of the policy and endowment in case that we are discussing is that you are largely given a very clear understanding that this is the kind of money you can expect when you stay invested. Because largely all of that investment happens in the fixed income, and you are never given a choice to choose between asset classes while you invest in endowment. ULIP is a market-linked product. So when you invest in a ULIP, you ideally can choose between either wanting to invest in equity fund or a debt fund or a hybrid. And it also allows you to switch between these funds. So you might start off with investing in equity, and then probably for some reason you might want to switch to debt or hybrid, and you are free to do that. So ULIP is largely a market-linked product, which is not really the larger case with endowment. Now, the problem with ULIP is, amongst the other things that we already spoke about in general, which are problems with insurance as an investment product. But in ULIPs, you have a 5-year lock-in, which is another problem. Also in ULIPs, most cases, the cost of investing in ULIP is very high, right? So when you invest in a mutual fund, you pay an asset management fee, right? Or a TER. But while you invest in an insurance policy, you pay a premium allocation charge, you pay a policy admin charge, you pay mortality cost and fund management fee. And like I was explaining on the endowment side as well, that if your age is higher, right, a larger part of your investment is taken away to give you sum assured. So while you're trying to invest in a ULIP, in terms of investment, you will have to compulsorily buy an insurance, right? Even if you don't want. And out of the 1 lakh rupee, the example that we are discussing, depending on your age, a larger sum is removed out of that 1 lakh rupee compulsorily to give you an insurance, because ideally it's an insurance product.
Okay, got that. That was very well explained, actually. So that's the case against ULIPs and traditional policies, and why you should never mix investment and insurance. Got that. Let's now go to the next thing you should avoid, right? Sectoral or thematic investing, and why that should be avoided. So here is a case, to sort of explain to you why you shouldn't invest in thematic or sectoral funds. Now, they are simply funds which invest in a theme. Any theme. It could be renewable energy, it could be in a particular sector, say infrastructure. Now, these funds are high-risk, high-return strategies. Timing is very crucial. It's a crucial element of investing in these categories. If you get the timing wrong, your returns can be extremely lumpy. This also defies the purpose of diversification and can add a lot of concentration risk, because what you are primarily doing is investing in one particular space. Now, whether that sector does well, doesn't do well, you're not, you're putting all of your eggs in one basket, and hence perhaps you should avoid it. Kirtan, come in on this. Do you recommend any kind of sectoral or thematic funds, or would you agree with me that this is, a place a retail investor should avoid?
Sonia, I think you've covered the points very well. I think retail investors, largely in my opinion, should avoid thematic funds or sectorial funds. Thematic or sectorial funds can be a very good proposition for, let's say, a sophisticated investor who can actually time the market cycle really well. Now, we can go back and see how metals went through a rally, or probably pharma and IT went through a rally during the COVID, right? We probably are currently seeing how banks are going through a rally. But while you invest in a particular sector, right, like you rightly pointed out, first, what you're doing is defining the reason or the purpose of doing these investments, which is diversification. So when you invest in a particular sector, you're largely putting a lot of concentration risk, right? And typically these sectors are cyclical, or the returns are very lumpy. So if you're not able to get out of these funds at the right time, right, you probably might end up losing all the returns that you would have made over a period of time investing in that particular sector. So while sophisticated investors who can, actually time the market and understand when to enter and exit can surely look at investing in thematic or sectorial funds, because it definitely makes you a lot of alpha over a diversified fund if you've been able to time it well. But for retail investors, it's a strict avoid in my opinion, because you are actually missing out on the logic of diversification for which you are investing, and hence a diversified fund would do a better job on a risk adjusted basis than investing in a thematic or a sectorial fund.
Okay, you do know, right, that we could get a lot of backlash for this from our mutual fund fraternity, because a lot of people are coming out with thematic funds, sectoral funds lately, but it is what it is. I mean, we're just trying to put out the risks there for our viewers, investors, so that, they make the right investment decisions. So there's are two things that you should avoid. One is, keep investment and insurance separate, and the second is avoid thematic funds. Let's do one thing. Let's take a short break, but don't go anywhere. We have 3 or 4 more things that you should be avoiding in your investment journey. We'll come back with that. Welcome back, folks. You're still watching Smart Money on CNBC-TV18. I have with me Kirtan Shah, founder and CEO of Credence Wealth Advisors. And today we're discussing what you should not be doing in your investment journey. So all the products that you need to avoid. Let's now discuss about the importance of asset allocation strategy in your investment journey. Now, you always need to have the right asset allocation and plan. And one thing that you should avoid is you should never keep all your eggs in one basket. Do not have 100% in either equities or 100% in fixed income. Now, 100% fixed income portfolios have never been able to beat inflation post-tax. So it's pretty much like taking your money, just digging a hole in the ground and putting it there. It's never going to grow. Kirtan, come in on this. The right asset allocation strategy is so important, especially at a time like this when equities have taken a back seat, gold has done very well. So what is your recommendation here?
I think, Sonia, what's important to understand as a retail investor, that the reason why most retail investors are not able to do proper wealth management, or they are not able to experience the wealth creation journey, is because apart from everything else, the bigger problem is the behavior, right? Because you've not been an investor for a long time. You've not seen a lot of ups and downs and volatility in various asset classes. And hence you tend to kind of take steps which are not very prudent from your investment standpoint. That is exactly where I think asset allocation plays a very important role, because all it will do is, depending on your risk appetite, if you've got your asset allocation correct, it'll keep your behavior in check and help you make or help you stop making random unnecessary decisions. Because typically what happens is, even when you are, let's say, a very aggressive investor, right, and you are okay with the volatility of the markets, but if you keep 100% of your investments in equity, time and again we've seen with investors that when markets fall and they know that markets are going to recover at some point in time and they want to allocate more money, they would typically not have more cash. That's exactly where asset allocation comes into picture, that even when, as an aggressive investor, had you had 20% in fixed income, you would have been able to buy equity markets at a lower level. And like you rightly pointed out, I think 100% in fixed income has never been able to beat inflation post-tax, right? I understand that if you are conservative, you would want to put 100% in an asset which is less volatile. But even if you do a 70-80% fixed income and a 20% equity with some element of gold, and if you have a 3-year of investment horizon, your portfolio is not going to see a lot of volatility, right? So even though you are conservative, a 20% allocation to equity or gold will not really push you to change your behavior, because your portfolio is not going to move aggressively. So I think if the retail investor really wants to be able to maintain discipline and create wealth over a period of time, I think what has to be kept in check is their behavior, which actually asset allocation, if done the right way, will help them.
Okay, all right. Now, there's one more thing that you should avoid, right? Investing in instruments that you don't understand. So that's what I'm going to talk about next. Retail investors should try and avoid all products that they don't understand. And there are several such products, whether it's small cases, whether it's PMSs, AIFs. Now, in a PMS, you end up investing a large chunk of money in one fund. So a PMS has a minimum ticket size of 25 lakhs. So you invest in one fund with one fund manager and one style of investing. It's always better to spread your investments across market caps and different styles of investing. So perhaps that's the reason maybe you want to avoid PMSs. But Kirtan, you tell me, what are the instruments that a retail investor should perhaps avoid? Maybe because they just simply don't understand how they function.
Sonia, I think very honestly, in my opinion, there is nothing better than mutual funds that probably you should look at as a retail investor, because at the end of the day, if you want to do equity, you want to do fixed income, you want to do gold, you want to do international investing, you have everything made available because mutual funds allow you to invest in all of these asset classes. The problem is when a lot of retail investors get carried away with products like AIFs that they don't understand absolutely, right? There is hardly any data available. The ticket size is so large, right, of 1 crore that you end up taking concentration risk by investing almost all the money that you've accumulated so far in one asset class and probably with one fund manager. Even if you talk about small cases, there is so much of lack of data or lack of historical performance data points that you really have as available. And because there is so many of these products are not so highly regulated like mutual fund is, you don't even know if things go wrong. How do you actually end up making sure that your portfolio is not hampered? And like you rightly said that, if I have 50 lakh rupees to invest as a retail investor, hypothetically, right, instead of doing 50 lakhs in a PMS, which is the minimum ticket size, I might as well do 10 lakh rupees into five mutual funds, where I'll be able to, work with 5 different fund managers, 2-3 different investment strategies. I can diversify my fund across large cap, mid cap, small cap. I'll be able to do so much by investing the same 50 lakh rupees in a mutual fund versus giving that 50 lakh rupees to one fund manager and taking that concentration risk. So definitely, I think the simpler you keep your investments, the longer you will be able to sustain, because it'll not give you unnecessary pullbacks, which otherwise you would receive if you've not understood the product that you are investing.
Okay, fair enough. So concentration risk is something that you should avoid, right? So better to not park your money, a large chunk of money, in either a PMS or an AIF. But let's now also discuss about fixed income investments. Now, fixed income investments is not for generating high returns. So remember that fixed income is for capital protection and it's not for generating high returns. The common mistake that investors generally make is to take a credit risk. So avoid taking large bets in one bond or one particular fixed income product. Fixed income is still, Kirtan, a space that a lot of people can't navigate easily. Tell us a little bit about that. What are the do's and don'ts here?
Sonia, I think this is a very important discussion on this talk of ours, is because because while we interact with clients, we see that everybody is looking at generating higher returns, right? And even when you are wanting to generate higher returns on the equity side, it is understood because the asset class is meant for growth. But there are so many of these investors who want to, kind of experience extremely high returns even while they are doing fixed income investing. Now, fixed income investing has a couple of problems, right? First, you have to understand that when you try and look for higher returns, you invariably, if you understand or don't understand, that is secondary, you invariably end up taking higher risk. So if there is a product which is paying you 8% versus a product which is paying you 12% fixed, it's a no-brainer that the 12% product is taking higher risk, right? The problem is that most of us don't understand what are the various risks in fixed income, and should we or should we not invest in that 12% because it is paying a slightly higher return, but whether we'll be comfortable with taking that risk. Now, the problem here is that in equity, while you invest, you know for a fact that you are taking a risk, right? And you know that the 100 rupee of capital that you've invested can go down to 90. But there is a probability that 100 can become 120. The problem with fixed income is that most investors don't really understand that the risk can lead to a complete capital and interest wipeout, right? Unlike equity, where you lose capital, there's a probability that you can get the price back. In fixed income, 9 out of 10 times what happens is, if you got your bet wrong, right, and if the company defaults, you lose your entire capital along with interest. So in fixed income, while you're trying to invest, I think at least the way I look at it is look at fixed income from a capital protection standpoint. Of course, if you understand how to invest in fixed income, you can definitely generate some alpha, but do not try and maximize your returns in fixed income, because invariably, whenever you will try and pick a fixed income product which pays you higher returns, there is definitely going to be higher risk, which you may not understand.
Okay, that was a very helpful, analysis and some helpful tips on what one should be avoiding in their investment journey. With that, it's a wrap. Kirtan, thanks a lot for joining in. We've run out of time, not out of questions, of course. But in case you have any feedback on the investment advice, the investment tips that we give out, and anything that you want us to cover on the show, please write into us and keep watching CNBC TV 18. Have a great weekend.